And Aditya, I would love to understand what is the significance of this higher ROE that India enjoys, because we know that during the past decade, a lot of commentators have said that that was a principal reason why India used to trade at a premium. Is this still a key reason for why India could stay at a premium? And therefore, in the event of a correction, could this be one of the drawing factors as well?
Yeah, so just to explain the graph again, what we're showing you is, again, forward ROE expectations for consensus. And the point which we make is that in terms of an outlook, we are, as a market, set to improve from a 12% ROE outlook towards about a 16% number, which is constructive. Now, the significance of this is as what you were kind of pointing out, which is that I think quality stands out, right? So quality stands out as a support factor, and in particular, as a factor, it really stands out in the event of pullbacks more globally, right? So I think this would be a key characteristic which continues to be in India's favor. When you kind of overlay the fact that you have growth in the market as well, a lot of themes, so on and so forth, this entire quality compounding characteristic for the overall market will again, I think, be a support factor here for us right? Now, just on the premium in itself compared to emerging markets, today is about 300 basis points. By that, what I mean is, if India is at 16%, emerging markets, the expectation is about, say, 13%. That 300 basis points premium in itself is not too dissimilar from history, though. So whilst it is a support factor, Neeraj, is it an explanatory factor to suggest why India is sitting at 22 times 2-year forward multiples? It's not. So it goes into the mix, but just on growth, just on returns, these are helpful, but they don't really tell you the full story. It still comes back to, at least empirically, when in the note we kind of go through this in detail, is that just in growth, just in returns, just in foreign flows, we can't really defend why, as a market, we should be at these levels. But then when you kind of think about the domestic liquidity piece, it then kind of comes together, and we can kind of, these valuations start to make more sense.
Okay. But so that, agreed, it's a mix. Obviously, it won't be a single biggest factor, but as important, I mean, is that a strong enough important reason, coupled with the fact, Aditya, that now, again, as one of the other charts in your report shows, India's weightage in the EM basket as well for passive flows too, right? Much higher than what it used to be, the differential much lower versus China. So whenever the EM flows gush back, presumably post the rate cut or otherwise, does that also aid the probability of flows? So higher ROEs, more weightage, stable earnings growth, does all of this augur well for flows? I'm just trying to understand from somebody who looks at this more closely and is more informed than most people about when do foreign flows make a comeback.
But I think that's exactly it, right? So I don't think India on its own, at least in terms of foreign liquidity dynamic, just going back to 2023, right? Yes, we saw a lot of flows coming in, but the backdrop was that EM ex China as a group saw a lot of inflows, and within that we saw a greater capture of those flows, right? So I think the starting point has to be that EM ex China as a category is going to see more inflows, and within that, I think India will continue to stand out as a benefactor of these kind of benefactor of these flows. But I think as a category, as a group, we've got to see the inflows first. I don't think India on its own is going to see foreign allocations expanding, at least from foreigners.